My name is Melissa Critcher, and I'm going to be your discussion leader for our time together today. We do have lots of material to cover, so I want to make sure we just go ahead and jump right in here so that we can make sure you have all the information that you need in order to complete an audit of an employee benefit plan. So our learning objectives for our time together, by the time we finish, you should be able to define the various components related to employee benefit plan audit procedures, as well as identify some of the common errors and mistakes made by plan sponsors, as well as auditors, and also recognize the various areas that are of pretty much investigative focus by the Department of Labor. So this course will be an overview of how to design audit procedures in direct response to the assessed risk of material misstatement, the common audit procedures for employee benefit plan engagements, how the auditor should respond when operational and/or administrative errors are identified, other audit considerations such as maintaining the plan's qualified status, and then financial statement preparation and reporting process. So that's an overview of the topics that we're going to be covering today. It is broken out into about 5 different sections. So we're going to start first with designing the audit procedures, and this is going to be in direct correlation to the risk assessment process, where we've already talked about steps 1 and 2 in the risk assessment process, where you identified the risk and assessed the risk. Now we're at that step 3, where we are responding to those identified and assessed risk. And so we're going to talk about the procedures that you're going to design and perform, those different types of audit procedures in section 2 here, specifically related to employee benefit plans. And we'll talk about the best practices and some ideas to hopefully assist you in becoming more efficient and more effective. And then section 3, we will talk about responding to errors that are identified during the course of our audit. One thing too that I want to mention now, in case I forget to a little bit later, employee benefit plans are a little unique in that we are auditing the financial statements, but there's a compliance component to every EBP audit as well, where we're testing that the plan is operating in accordance with the plan's plan document. That's where that compliance piece comes in. So some of these areas that we're going to be testing, you're not going to see on the plan's financial statements. Things such as eligibility, things including allocations to participant account balances, those types of items. We still have to test them, but they don't show up on the financial statements or even in the disclosures. And the reason I mention that is because when we identify errors and mistakes in an EBP audit, those errors and mistakes have to be corrected, because when those errors or mistakes impact the participants and or their accounts, those have to be corrected by the plan sponsor. There is no materiality from that perspective in an EBP audit. So that's another unique factor about an employee benefit plan engagement, is that yes, there will be times you do identify errors and mistakes made by plan sponsors, and we have to know how to advise and or assist the plan sponsor with getting those corrections made properly. And then section 4 is where we'll cover other audit considerations, including things such as, what are those compliance tests that are required for plans in order to maintain their qualified status. We'll talk about some other unique considerations related to initial audits and plan terminations, and some new legislation, just as a reminder of some of these things that you need to know for the future when it comes to employee benefit plan audits. And then we'll wrap everything up with financial statement preparation and reporting. So let's go ahead and get started here with Chapter 1, Designing Audit Procedures. As I mentioned, the audit procedures that you're going to be performing have to be in direct response to your identified risk. So it is critical that the substantive procedures that you perform during your audit link back directly to those assessed risk. So in other words, you don't want to perform any procedures that you cannot tie and link back to an identified risk, and vice versa. The client-specific risks need to be taken into consideration when planning the audit. Yes, there are going to be some similarities from one engagement to the next. For example, considerations related to eligibility, enrollment, contributions. The broad theories are going to be similar from one engagement to the next, but each client will be unique in regards to what are their eligibility requirements, for example. Is everyone eligible to participate from day one of employment, or do they have to be age 18 and complete 6 months of service? What are the different types of contributions that are allowed? So these are some of the differences that are going to be unique to each client. And those differences, are going to represent potential risk. And so you're going to have to respond to them appropriately. Now, there are several possible issues that could occur if the risk assessment is not linked to the testing that's done during the audit. For example, if the risk assessment does not drive the selection of the audit procedures, then you may find yourself doing unnecessary work and viewing that as standard and included in the audit. That's going to have a negative impact on the overall efficiency of the engagement. Now, the flip side of that is if the audit procedures are not determined based on the specific risk for the client, then you may be gathering insufficient or unrelated audit evidence and then not have sufficient testing and documentation in order to support the opinion. So this can go both directions. So it is a formal process, and it is designed to make sure that you are spending and addressing the areas that have the higher risk and spending more time on those areas than areas that have a lower risk. Now, when you're designing those audit procedures, you're using your professional judgment to determine the nature, timing, and extent of the procedures that you're going to be performing. And then based on the nature of the identified and assessed risk, you're going to then determine what type of procedures to perform, whether you're going to be performing analytical procedures or substantive test of details, inquiries, or some combination of all of those. So, for example, with your analytical procedures, that may include some common ratios unique to employee benefit plans or even fluctuation analysis. The one thing I do want to stress is that if you are using analytical procedures, you have to include your expectations for those analytical procedures. Your substantive test of details can include things such as inspection of various documents, whether that may be enrollment forms, or it could be inspection of information that provides proof of the date of hire, date of termination, date of birth. You could do some recalculations in regards to recalculating the amount that was withheld from the participant's wages. And of course, various reconciliations are also examples of substantive test of details. Inquiries. Yes, we all utilize inquiries throughout the audit process, but you need to remember that you need to document for that inquiry who you inquired of and when, what the inquiry itself was, the response, and then you have to substantiate that response. That's basic audit documentation. But the tests that you actually perform, as I said, you're using your judgment to determine which of these or what combination of these you're going to be performing that is in direct response to that identified risk. The timing of the test to be performed is also a consideration in regards to your planning and preliminary analytical review process, the fieldwork and detailed testing, and the wrap-up and issuance of the report. As we know, and as we defined previously, is that the filing deadlines for employee benefit plan audit engagements is a little bit different. They have to be filed within 7 months after the plan's year end, and they could get an automatic extension for an additional 2.5 months. So we need to factor in the timing of those deadlines when we are looking at starting our planning process and completing our fieldwork and detailed testing. This will also have an impact on the extent of the test to be performed. How the audit will be performed on a test basis is going to fluctuate between large and small sample sizes. And again, that's going to be based on auditor judgment as a direct response to those identified risks. So the example that we have here, the auditor needs to realize that risk exists based on the decision to use a sampling and on the size of the sampling. So that's where we're going to be modifying some of the extent of the test that we are performing by increasing or reducing the sample sizes. The risk of incorrect acceptance occurs when the testing of the sample indicates that no material misstatement exists. But when all items are tested, material misstatement does exist. So that's that risk of incorrect acceptance. The risk of incorrect rejection occurs when the testing of the sample indicates that material misstatement exists, but material misstatement does not exist when all items are tested. So, those are very technical, examples and terminology. The easiest way to look at this is, based on your identified and assessed level of risk, you want to properly determine a sample size that will help you determine that a material misstatement does not exist. That's ultimately what you're after. And again, I said this earlier and I want to re-emphasize it here. When you're selecting a sample and you're testing in an EBP audit, if you have, for example, your sample size of 20 and you have 2 that appear to be incorrect, and I'm getting a little bit ahead of myself, but I want to mention this here, and we will come back to it later on in our discussion when we look at specific examples of work papers. Let's say you're testing the contributions and the definition of compensation. So out of your sample size, whatever it may be, let's say you find 2 that appear to be incorrect. And it appears that maybe they've used the incorrect definition of compensation. Now, this is for 2 people in your sample. As the auditor of an EBP, you cannot rationalize and simply say, okay, well, that's only for 2 people in the sample. It's not material. We're just going to move on and pass on any further procedures. You can't do that on an EBP audit because in this example, you had 2 people in the sample size that did not have the correct amount withheld because they did not use the correct definition of compensation. That has to be corrected, because that is a scenario where they are not in compliance with the plan document. So those participants have to be corrected and made whole. And furthermore, you now have to also expand your inquiries to determine, is this something that was isolated to just those 2 people, or does it extend out to more people in the plan as a whole? Because everyone would have to be corrected. So that's what I was referring to earlier when I said, the EBPs are a little bit different in that you can't just simply look at your materiality and say, okay, this is immaterial and move on, because if it's a compliance issue, that has to be corrected. So responding to that assessed risk, we have to emphasize to the audit team that we always have to maintain professional skepticism. So some of those responses based on that level of risk may require us to assign more experienced staff, or possibly staff that have more specialized skills, or maybe even outsource it to an external specialist. Again, that could be one of our responses based on that assessed level of risk. We may respond by providing more supervision. We may respond by incorporating more elements of unpredictability. We may also respond by simply changing either the nature, the timing, and/or the extent of the actual audit procedures we perform. So those are just some examples of responses to the assessed risk. Test of controls versus substantive test of details. There's always lots of confusion, and we've had lots of discussion over the years in regards to test of controls versus substantive test of details. Your substantive test of details verify if the information itself is correct, such as if their date of birth and their date of hire in regards to the plan information, is that correct? Whereas a test of control determines if the information that's managed by a system supports correctness. So a test of control is one in which we're testing to make sure that the control is in place to prevent and or detect or correct a misstatement. These are two different things. Your substantive test of details always have to be performed in an audit engagement. A test of controls does not have to be performed, but you have to consider testing controls. If you are going to reduce your control risk below the maximum, then you have to test those controls. And that would be a separately designed test of control. Now, you could have the possibility for what's called a dual purpose test. And a dual purpose test is one that combines a test of controls while simultaneously including substantive test of details. And for an employee benefit plan audit, dual purpose testing can be a good possibility, but you would have to make sure that you appropriately and sufficiently document, how those procedures serve as a test of controls and simultaneously serve as a substantive test of details. These are a few areas where you may be able to incorporate a dual purpose test on an EBP audit in regards to payroll, contributions, distributions, and participant loans. So for example, for your payroll and or contribution testing, you could perform a dual purpose test in that you test the payroll amount to ensure that the amount that the participant was paid is what they were supposed to be paid. So you're testing the controls surrounding the payroll and testing the control to make sure they're using the correct definition of compensation, to allow you to be able to test that the amount that was withheld from the participant's wages is what they wanted withheld. So it's one of those examples where you're testing possibly the control itself while at the same time performing a test of details. Again, you have to be very careful here with your documentation to make it very clear the purpose of the test that you are performing. When you are responding to the identified and assessed levels of risk, you are going to be designing those procedures as we've mentioned, but that's also going to require you to possibly modify those audit programs. And generally with audit programs, they are separated out between your basic types of procedures, which would focus more or less on analytical procedures. And then as possibly the risk increases, you may perform what's called limited procedures, which would be your basic substantive test of details. Then for those highest levels of risk, you could have extended procedures. And those extended procedures for your high levels of risk, you would only apply for those assertions where you've assessed the risk at high. So you wouldn't have to do extended procedures for every assertion, just for those assertions where you have identified a high level of risk. What you want to be careful about on your audit programs is you want to make it clear that you have designed those audit programs to correspond and link to your identified and assessed risk. So you really shouldn't have any of your audit program steps marked as not considered necessary or not applicable, unless, of course, you are using paper copy audit programs, and then you're not going to have a choice but to mark certain procedures as not applicable or not considered necessary. And if that's the case, then you want to be sure that you explain why those audit procedures are not applicable or not considered necessary. So sampling is very important when it comes to helping design and perform your actual testing. A couple things here I want to mention about sampling as a whole is that There are two ways to approach sampling. You have statistical and you have non-statistical. And most people have a tendency to use the non-statistical approach. Either one is perfectly acceptable. With a statistical approach, basically it says each item has an equal chance of being selected as part of the sample. And with your statistical approach, you're generally using those sampling tables from the sampling guide. And you're still using some judgment even with the statistical approach in regards to your tolerable deviation rate, your expected number of deviations, that type of thing. And then you find the appropriate table and you find the sample size. The majority of people, at least it's been my experience, have a tendency to use a non-statistical approach. And the sampling rules basically state that if you're using the non-statistical approach, then your sample size has to be similar to what the sample size would have been if you had used a statistical method. And this has been tested time and time and again over the years. When it comes to the non-statistical approach, if your sample size is anywhere between, I don't know, let me just make up some numbers here, basically a sample size of 3 up to something crazy like 100, then that sample size for a non-statistical approach, you can make that similar to the statistical because, like I said, there's judgment involved in both. With your sampling, regardless of whatever method that you use, there are certain rules that have to be met and have to be documented. These rules, when it comes to sampling, the first thing you have to do is determine your sample size. And that's where that typical non-statistical approach is going to come into play. So you're going to have to document how you determined that sample size. Whether your sample size is 10 or 20 or 40 or 60, whatever it is. How did you come up with that number? PPC has a checklist that can assist you with determining the sample size. Knowledge Coach also has some forms that can assist you with determining sample size. Your firm may have their own methodology for determining a sample size. As long as you're documenting these items, then it doesn't matter which tool or checklist or methodology you're using as long as you document these items. So what is the basis for your sample size has to be documented. How did you determine you have a complete population? What was your sample selection method? Was it haphazard? Was it systematic? Was it random? Was it judgmental? How do you define a deviation? You have to document the results of your procedures and how any variances were addressed. If all of those items are documented when it comes to your sampling, then no one can tell you that your sample is incorrect or inappropriate because sampling is based on professional judgment. Now, the only time I've seen issues when it comes to sampling from a peer review perspective or from Department of Labor, for example, is when the sample size was 1 or these items weren't documented. So first of all, 1 is not a sample size. And these are the required elements to be documented. So you have to be able to document and support those decisions regarding the sample size and the method of sampling. Now, there's a methodology that I've used for quite a few years, and it's worked well for me. And I do vary my sample size from one client to the next, even while following the same methodology. For example, I will typically identify my clients as a large plan or a small plan, and this has nothing to do with the audit requirement. It's just for sampling purposes. And so I'll define what I consider to be a large plan. So let's say, for example, I will say a plan that has more than 1,000 participants. I'll consider that to be a large plan. A plan that has 300 participants, I'll consider that to be a small plan. And so my sample size then for my small plan may be 20, whereas my sample size for a large plan maybe 40. Again, these are just some examples that I'm providing to you, and then I complete the rest of this documentation. Now, let's say I've been auditing that plan for, I don't know, let's say I've audited that plan for 3 or 4 years, and there haven't been any issues or problems when it comes to that plan. So if it's a small plan, I've audited, let's say for the last 3 years, my sample size was 20 each of those 3 years. Maybe now I use my professional judgment and say, okay, they haven't made any changes in their personnel regarding the individuals responsible for the plan. They haven't changed service providers. There's no major amendments. I haven't found any problems in the last 3 years. Okay, maybe I reduce my sample size from 20 down to 10. And guess what? That's perfectly acceptable as long as you document your reasoning and your basis. That's the key here. These items have to be documented. So sampling, ISA 530 considers 5 different methods of audit sampling. We're going to talk about each one of these, and they're all perfectly acceptable. The first one is random selection, whereas all items within the population have an equal chance of being selected as part of the sample. Random is a very popular selection method for all types of audits. Systematic is also a very popular type of selection method. And basically what they do with systematic is items are selected at specific intervals. So maybe every 20th item is selected. That's a systematic. So the example they have here, the auditor of trade winds is undertaking substantive testing. The source documents for the testing area are numbered from 5,000 to 15,000. The random number generator suggested a start at 77 and a sample size of 75. So the auditor starts at number 5,077. That's the random number generator start, and then samples every 100th document until achieving a sample size of 50. So that's an example of systemic or systematic selection. You could also use monetary unit sampling. This includes a value-weighted selection and turns monetary amounts into sampling units. So this example is where you have a participant contribution of $5,000 per year, occurs in 100 employee accounts. So the sample will be determined by using the $5,000 as the maximum number. So the sample will be between 1 and 5,000. So the sample size will be 50. Now, I don't typically see many people using monetary unit sampling in an EBP audit. I think that may be more useful for other types of financial statement engagements. But again, that'll depend on your professional judgment. It'll depend on the nature of the plan. It'll depend on many different factors. But it is another type of sampling that could be utilized. You could also have haphazard selection. This is another common selection method used in EBP audit testing. There's no set approach when it comes to selecting the sample in haphazard. It really is just haphazard. And you typically do not use haphazard for your statistical sampling. Haphazard would be used more with your non-statistical selections. And then block selection is the last one they have listed here. A block of contiguous items is selected, and this method is also typically not used as there's no assurance that the outcome is accurate beyond the block of time that the sample represents. So don't typically see block selection in an EBP audit either. Now, the one that's not listed here that I still want to mention is judgmental sampling, and that's because they pulled these 5 from the ISA 530. But another common approach when it comes to sampling is judgmental selection. In fact, the reason I paused there is because I want to basically emphasize that in my professional opinion, I think judgmental selection is the most appropriate for an employee benefit plan audit. Now, your random, systematic, and haphazard may absolutely be the best methods on other types of financial statement engagements. But for your employee benefit plans, I think the judgmental selection method is the most appropriate. The question then becomes, why do I say that? Well, that's because when I'm looking at my population and I'm determining which items to select, in an employee benefit plan audit, some of the areas that we mentioned earlier that we're going to be testing include eligibility and the different types of contributions, the different types of distributions. So by using a judgmental selection process, I am judgmentally selecting who I want to test to make sure that I cover all of the different aspects of the plan. So for example, out of my sample size of 20, I've determined that I have a complete population, so I may select 10 from the year-end payroll and 10 from the participant individual account balance report. So out of those 20, I am purposefully selecting somebody that was newly hired during the year, somebody that terminated during the year, somebody that was eligible, or more than one that's eligible and participating, someone that's eligible and not participating, someone who had a participant loan, somebody who's highly compensated, non-highly compensated, someone that had pre-tax deferrals, someone that had Roth deferrals. So I'm judgmentally selecting all of these different parameters based on the plan provisions to include in my sample selection. If you're using random, systematic, or haphazard, you may not select someone who was newly hired or eligible and electing not to participate. So then you may have to increase the number of items you're testing to be able to incorporate those factors if you're using random, systematic, or haphazard. So I do like to just mention that judgmentally selecting your sample is an appropriate method. And for employee benefit plans, in my professional opinion, I think the judgmental selection method is preferred. So those are some of the different sampling techniques and the requirements when it comes to your documentation for sampling. And again, sampling is one of those specific responses to the identified and assessed risk to help you determine also the extent of the testing that's going to be performed. So now we're going to spend some time talking about the common audit procedures and the specific procedures for those common employee benefit plan audit areas. And these are some of the areas that are unique to employee benefit plan audits. So the audit procedures that are subject to testing on all employee benefit plan engagements include your participant data, eligibility, and demographics, the contributions, distributions, participant notes receivable, your remittance testing, and then for investments, there are some differences for the investment procedures, and that's going to depend on whether you are performing an audit in accordance with ERISA Section 103A3C or a non-ERISA Section 103A3C. The investment procedures that you're going to perform, regardless of whether it's 103A3C or not, include the fact that you have to test the investment income that's allocated to the participant accounts, and you have to test the participant's ability to change their investment allocation percentages. Those two steps and tests have to be performed regardless of whether you're doing a 103A3C audit or not. If you are performing a non-103A3C audit, then you are also going to be testing the investment purchases, the investment sales for realized gains and losses, the investment fair value, and unrealized gains and losses. But those are only performed in a non-103A3C audit. And then your remittances, I think I mentioned that a second ago. These are, the areas that have to be tested on an EBP audit, every EBP audit, where they're applicable. Now, not every plan will allow participant notes receivables. Not every plan will have remittances. For example, your defined benefit plan, they don't typically have employee contributions, so therefore the remittance test is not going to apply in a DB plan. So we're going to look at some examples for each of these areas and talk about some of the best practices in addition to what is required when it comes to performing these tests. So starting with participant data. The objectives here for the participant data include the fact that we have to determine, is the information complete and accurate? Have all eligible employees been included? And have ineligible employees been properly excluded? So there's various types of information that we're going to be looking at here. It's the demographic information that helps us determine whether or not that participant is eligible or ineligible based on their birth date and hire date information. We're going to be testing payroll information related to participant data. And we're going to be testing the individual participant account balances because those individual account balances represent the benefits that are due to that individual participant. So we're going to test the amounts that are allocated and contributed to that participant account. So participant data is critical for every employee benefit plan audit. And I'll go ahead and mention now too that employee benefit plans and their supporting information has changed over the years, just like lots of things have changed over the years. When I first started doing these audits 100 years ago, we had a piece of paper for everything associated with the plan. And we would have personnel files that were sometimes 2 or 3 inches thick that contained every scrap of paper and information from day one that employee was hired. Well, now you may not have hard copy paper documents for anything, or it could be some combination of hard copy paper and electronic information. A lot of this information, the demographic information and even payroll information, may be stored electronically. And maybe the client has an HRIS system where, again, all of the information is housed electronically. And we'll talk about that in more detail as we go throughout our discussion. But it doesn't change the fact, regardless of whether it's in hard copy paper or it's in electronic format, it does not change the fact that we still have to test that information. What's going to change is maybe how you go about testing that information. So with our participant data, the eligibility requirements are going to be different from one plan to the next. Some plans may require the employees to reach age 18 or age 21 before they're eligible. They may have to complete a specified period of service, whether it's 30 days, 6 months, or even a year. And birth date and hire date, even termination dates. We're going to have to examine proof of this information. And some plans may even have the automatic enrollment features and automatic contribution arrangements now. I would say as little as probably 5-6 years ago, the majority of my plans were not any type of automatic enrollment or contribution. But now, I would say probably 75% of the plans that I audit are some type of auto-enroll, automatic contribution arrangement. And I think a lot of that's because there's been a significant emphasis placed on retirement planning and savings, by all the different parties, plan sponsors and service providers and the government and legislation, that they're really wanting to increase retirement savings. So I think that's been part of that transition over to more of these auto-enroll and automatic contribution arrangements. So when we're testing the participant eligibility and demographic information, we're asking for proof of that person's birth date and hire date, and we're testing that to make sure that that individual was eligible and offered the ability to participate, or that they were ineligible and properly excluded. That's what we're testing here. And again, you may not have an enrollment form. You may not have any hard copy paper that participant completed that shows, here's my birth date, here's when I was hired, etc. If it is housed in one of the HRIS systems, then don't be surprised when you ask for this information if the plan sponsor says, oh, can I just give you a screenshot? Because it's all in the computer system. And so you have to sit there and think about that for a second, because if they're offering to give you a screenshot, that's going to list that person's name and address and social and birth date and hire date and term date and compensation and maybe even their deferral percentage. Well, that would be very handy to just be able to use a screenshot. Well, guess what? Especially the first time. If this is a new client for you or they just switched over to this system, you can't just rely on the screenshot without testing that information in some manner. So this is an example of when you're going to probably have to do a test of controls to test the information that's in the system in order for you to be able to rely on it for your substantive test of details. So in this scenario, if they are using the HRIS and everything's completely electronic and they don't have hard copies of anything, you're going to have to design your procedures to test how the information got into the system, what it was based on, and is it relevant and reliable and accurate and complete. Those are some of the concerns. So for example, let's say that you've got a client that has the HRIS, everything's completely electronic, and they're wanting to provide you screenshots. So now you're going to go about testing that information. How do you prove that that birth date and hire date and that social security number and all of that in the system is, like I said, relevant, reliable, accurate, and complete? One of the things that I would typically ask for is a copy of the E-Verified I-9, because they will generally still have those on file. And then I can compare the information that's on the E-Verified I-9 to what's in the system to get comfortable with what's in the system. Or if they don't have the E-Verified I-9, what do they have that can assist me with getting comfortable with the information in the system? Do they have a copy of their driver's license or social security card? Do they have any other type of form that was completed by the participant that's a part of that system that they scanned in? Worst case scenario is you may have to go and confirm that information directly with the participant. But let's say, okay, you do any and all of those procedures that first time to test that the information in the system appears to be complete, accurate, relevant, and reliable. Therefore, going forward, let's say next year's audit, you select your sample and they can provide you screenshots for everyone that was included in that control testing for the previous year. So it would only be new hires going forward where you would have to test their information being entered into the system, not for everybody in your sample. So that's a good example, an area of how things have changed, and maybe you don't have hard copy documents anymore and it's all electronic, where you could build in a test of controls to test how the information got in the system so that you could rely on that for your substantive test of details going forward. So participant data, again, your objectives here for testing the participant accounts, and this is that benefit piece of it, especially because with the defined contribution plan, the benefits that the participants are entitled to receive are based on those individual participant accounts. So you want to test to make sure that amounts are being properly allocated to those participant accounts in accordance with the plan document provisions. So one of the things that you are required to test is you have to reconcile the total participant account balances to total plan assets. That's a required step. You're also testing to make sure that, again, the investment income is properly allocated to the participant accounts, that the participant contributions are remitted and then deposited into the correct participant account, and that those transactions are properly authorized and executed in the appropriate period. So those accounts are part of this participant data and demographic information testing. So how do we document these procedures? I've got a sample work paper here for you, and this is just an example. So you've got your participants listed, and you've got their birth date and hire date that you either obtained from the participant account balance report or from the payroll report. But then you're testing to verify and prove that information. Is that person's actual birth date and their hire date? Then, based on the plan document, you determine and document whether or not that person was eligible. Then you're determining what is their elective deferral percentage and or their Roth percentage. Now, again, all of these plans used to utilize paper enrollment forms. Now, the majority of at least my plans, the participant enrolls online and makes deferral changes online, so I no longer have a hard copy document. But we still have to test that deferral percentage in some manner. Because once we identify what that deferral percentage is, we're going to then test to make sure that that is the actual amount that's being withheld from the participant's wages. And then you'll notice here that there are some columns, like if that person terminated during the year, we would list that termination date. And then you have the participant account balance. So one of the things I will generally do is for that beginning balance, I'll agree that to the prior year. I'll agree the ending balance to the next year. I'll have a total right down there at the bottom, the total of the participant account balances, and then show how that reconciles and agrees to total plan assets or net assets. So that I can show that I have reconciled total participant accounts to total plan net assets. Now this information, yes, you could send a confirmation directly to the participant and ask them to confirm their birth date and their hire date and their deferral percentages. Confirmations can be a good tool to help you with your testing. Now, I try not to send confirmations if at all possible, because there are some potential issues and hurdles when it comes to the confirmations. For example, you prepare the confirmation, you send the confirmation, and this is sometimes 6-7 months after the plan's year end. So let's say you send the confirmations out in June of that year, and you're auditing the previous December 31st year end. Sometimes those participants will not pay close enough attention to the dates, and they'll confirm that information as of that date in June, what their deferral percentage is at that date in June. Or they don't even bother responding. And so you're having to beg for the confirmation to come back. Or that participant takes the confirmation and goes to the HR person and says, is this information correct? Which is defeating the purpose of the confirmation to begin with. The confirmation, we're expecting that individual to go back to their records for that period of time and confirm that information. Now, they all should obviously know their birth date and hire date, but those deferral percentages and their investment allocation percentages, they may not go all the way back to that period of time because maybe none of that has changed for the last 12, 18 months. Me personally, I prefer to test this information in a different manner rather than using confirmations. I would rather look at something that participant has initiated or signed or completed versus having them get a confirmation, look at the confirmation and go, yeah, that looks about right, and then sign it and send it back. Because I find a lot of times, even when confirmations are being sent, that the auditors are also still doing a lot of this detailed testing on their own. So it results in some inefficiencies at times. I'm mentioning the confirmations here because any of these areas that we talk about, whether it's this participant data, whether it's the contributions, distributions, participant notes receivable, any and all of this information, with the exception of the investment income allocation, can be confirmed. And if used properly, confirmations can be a good audit approach. Confirmations are not required. I'm pausing there intentionally because I want to emphasize that confirmations are not required in any of our auditing standards for employee benefit plans. They're not required by the IRS. They're not required by the DOL. Now, I have had many people over the years tell me that their peer reviewer, or when they were audited by the DOL, they were told they had to use confirmations. And my suspicion when that happens is if they're told by the DOL or they're told by a peer reviewer that they have to send a confirmation, I'm a little bit suspicious that they really didn't do any work. Because if you're doing this detailed work and agreeing it to supporting documents, then you don't have to send a confirmation. But the bottom line is this information has to be tested in some manner. So in a scenario where you've got a plan where the participant enrolls online and they make deferral changes online, I've already explained how I would test the birth date and hire date. But if they don't have any paper documents for the enrollment and the deferral information because everything's handled over the internet, then in this scenario, the SOC report becomes very important. And so you would look to make sure that those participant-initiated transactions have been tested in the SOC report in regards to the participant securely logging in and initiating that transaction and or making that change in their deferral or the investment allocations, where they want 10% in this fund, 20% in this fund, 50% in this fund, etc. So you rely on the SOC 1 Type 2 report where those controls for those participant-initiated transactions have been tested. So then now you have to make sure that those participant-initiated transactions did take place. So yes, during the SOC 1 Type 2 report, they were tested, no exceptions noted. Now, for my part, I'm going to test that for that participant there, that very first one, Childress, that they wanted 4% for the Roth withheld. I can see that they did that online the control was tested in the stock report, I now go back and test to make sure that 4% Roth was actually withheld from their wages. So I'm relying on the information in the stock report, at the same time testing to make sure that it was carried out over on the plan sponsor side. So again, I'm not sending confirmations for that because I'm relying on the information in the stock report and I'm still doing the testing. But yes, you could also send that confirmation for that deferral percentage as well. And we're going to look at a different work paper that incorporates that testing related to those deferral amounts. So I've mentioned a couple of times when it comes to the changes over the years in regards to how the participants enroll. There's been an increase, or at least that I've seen with my plans, in plan sponsors adopting these automatic contribution arrangements. And there's different types of automatic enrollments and contribution arrangements. The simplest one here is that very first one, where the employer automatically reduces an employee's wages. They set up a default percentage that's stated very clearly in the plan. And then they contribute that automatically withheld portion over to the participant's account. And that's an automatic enrollment contribution. Very straightforward, very simple. Now, the next level is what's called the eligible automatic contribution arrangement, the EACA. It's similar to that basic one, the basic ACA, but with the EACA, there are some specific notification requirements, because generally what happens is that they will tell everyone, every employee, that they are now adopting this EACA, and everyone will be automatically enrolled in the plan at that default percentage. And then with the EACA, it allows employees to withdraw those automatic contributions within 90 days of that first automatic contribution. So if they want to opt out after the fact, they can opt out within 90 days and withdraw those automatic contributions, including earnings. So that's your EACA. Then you have your QACA, your Qualified Automatic Contribution Arrangement. And this again is similar to the EACA, but takes it to another level. You still have the same communication where everyone's automatically enrolled at that default percentage, but the QACA also has additional safe harbor provisions, which requires a contribution from the plan sponsor. And because the QACA has this additional safe harbor provision, the QACA plans are going to be exempt from the ADP and ACP discrimination test. With the QACA, that default percentage generally starts at around 3% and gradually increases to 6% with each year that they participate. And that maximum QACA default percentage increases until it reaches the max of 15% now. Unless it's the participant's first year, then it's still at the 10%. And so that's your QACA. Now, with that safe harbor provision under the QACA that requires the employer contribution, the employer does have a choice as to what type of contribution they want to make. The first option is a matching contribution, where it's 100% match for elective deferrals that do not exceed 1% of compensation, plus 50% match of elective deferrals between 1 and 6% of compensation. The second choice that the plan sponsor has is they can make a non-elective contribution equal to 3% of compensation for all participants, including those that do not make elective deferrals. Now, the QACA employer contributions, the employees must be 100% vested in the match or non-elective after no more than 2 years. So those are your QACA plans. So it's very important that you do read the language in the plan document very carefully to determine, what type of enrollment is allowed and required, and how do the participants enroll, and what are those eligibility requirements. We're testing that regardless of whether it's a 103A3C audit or not. So the next step here in our testing relates to the contributions and payroll, and we've already touched on this a little bit. Payroll is a very important component of the EBP audit because so many different factors are directly tied back to that payroll. For example, the amount that the participant wants for their elective deferral and or their Roth deferral is going to be based on their compensation. So we have to test to make sure that the plan sponsor is using that correct definition of compensation. That compensation definition will be found in the plan document. Do not rely on the plan sponsor to tell you what that definition is. And I stress that because that definition of compensation is probably one of the most common mistakes and errors I see made by plan sponsors. Compensation can be defined, for example, as total gross wages, or you may see it defined as W-2 wages. It could be defined as gross wages excluding bonus and commission. Compensation can be defined many different ways, but we have to test to make sure that they're using that correct definition of compensation. When we're looking at that definition of compensation and we're looking at the contributions that are withheld from the participant's wages, you can approach this from a couple different perspectives. You can look at one or more pay periods during the year, or you can look at total compensation for the year. It's entirely up to you. There's a little key point here that they want to emphasize. Plans that are ERISA qualified plans provide participants a variety of protections. So under ERISA, a federally chartered corporation, PBGC, which is the Pension Benefit Guaranty Corporation, guarantees payment of certain retirement benefits should the plan be terminated. ERISA grants participants the right to sue for benefits and breaches of fiduciary responsibility. So those are some of the protections that are offered when it comes to these qualified plans. And they offer these protections because these plans are holding retirement benefits for these individuals. And the dollar amounts that are in these plans, are in the trillions. And so the government, the ERISA, the DOL, the IRS, they do really emphasize how important it is for plan sponsors to meet and maintain their fiduciary responsibilities when it comes to operation and administration of employee benefit plans. So we're testing that definition of compensation to make sure that they're using the correct definition in accordance with the plan doc. We're testing the contributions. And so if the plan allows for pre-tax and Roth and catch-up and other after-tax, well, then we're going to be testing all of those different types. The same goes for the employer contributions, depending on the different types of employer contributions that are allowed, whether it's the match and the profit sharing and or discretionary, or any combination of those. We also have to test rollovers into the plan and any other allocations to participant accounts, because a lot of times the profit sharing and or discretionary employer contributions, the way that they're allocated to participant accounts may also be directly tied back to payroll. All of these relevant plan provisions will be defined in the plan document. So as part of our testing, we're testing all the different types of employee and employer contributions to make sure they were in accordance with the plan document and the participant's wishes. So the contributions, first of all, the contributions coming from the employer and the employee, FINREC has stated that contributions are not considered revenue. They're contributions. Therefore, the employee and employer contributions are not subject to the revenue recognition rules because they're not considered revenue. They're considered contributions. With your employer contributions, those are recognized when they are owed to the plan. So for example, if the plan document says that the employer match will be made after every pay period, then they are recognized after every pay period. Whereas the participant contributions are recognized when they are withheld from the participant's wages. So if the last payroll in December, for example, and I'm going to give you two scenarios here. If the last payroll in December is on December 29th, and that's when the amounts were withheld from the participant's wages, well, that's when they are due to the plan on December 29th. So if they're then remitted to the plan on December 29th, then you have no receivable. However, if they are withheld on the 29th but not remitted until January 2nd, then that's a receivable to the plan at year end. The plan sponsor contributions, again, will vary depending on the language in the plan document. So if the plan document says that employer match will be made after every pay period, it's very similar then to how you recognize the participant contributions. So the last payroll, again, if it's December 29th and the match is made on December 29th, then that's when it's due to the plan. If it's remitted on December 29th, no receivable. If it's remitted January 2nd, then you have a receivable. But if that plan document language says that the employer contribution is completely discretionary, then you may not have any type of receivable for the employer portion, because the employer portion would not be due to the plan until they make a decision when and how much to contribute to the plan. So again, the language in the plan document will be very specific as to whether the employer contributions are discretionary or contractual. But we're testing these contributions once again, regardless of whether it's a 103A3C audit or not. The employee contributions are also going to have specific limits. Those limits can be specified again in the plan document, and they must be in accordance with the IRS limits as well. Forfeitures do not apply to employee contributions because the employee is always 100% vested in their own contributions. The plan document will also specify whether or not the investments, are they participant directed or non-participant directed? So if they are participant directed, then the employee gets to direct how they want their contributions allocated across the different investment options. The employee contributions, when those amounts are withheld from the participant's wages, they have to be remitted to the plan as soon as possible. If they are not remitted to the plan as soon as possible, that's a prohibited transaction and has to be reported on the supplemental schedule of delinquent contributions, disclosed in the notes to the financial statements, and the plan sponsor has to make up lost earnings. Those timely remittance rules, and we're going to talk about those in just a few more minutes. The timely remittance rules relate to all of those amounts that are withheld from the participant's wages. So that would be all of the employee contributions as well as participant note receivable payments that are withheld from participants' wages. So let's look at a work paper example here, testing payroll components and contributions. So we have the same people that we did on our participant data and eligibility worksheet. We've got, in this example, it looks like total gross wages for the year. The column next to total gross wages, you can see here, it looks like they're listing out some dollar amounts per hour, some hourly rates or salary amounts. You're going to use your professional judgment to determine whether or not it's necessary to test those hourly rates or salary amounts, that's going to go back specifically to your identified and assessed risk related to payroll component. And in most cases, we're finding that the risk that the participant is not paid what they're supposed to be paid is minimal. Now, again, that could be different from one client to the next. Some clients may have a higher risk related to that, but that's all going to be based on your knowledge of your client and where the risk lie. So I generally, again, depending on the risk, I'm not testing that hourly rate or that salary amount. I'm not testing it from the perspective, I'm not agreeing that salary amount back to supporting documents such as employment contracts or anything like that at the plan sponsor. What I am testing is that total gross wage number to make sure that that's in accordance with the definition of compensation. So then I have their deferral amounts from the forms or what they initiated online. And so if that person wanted 10% withheld, I look at the actual amount withheld from the payroll. I recalculate that amount withheld from the payroll. And you can see here for that first person, they elected 10%. But when you recalculated it, it only came out to 7.57%. Well, now you're going to have to reconcile that difference between the 7.57 and the 10. And this is also what I was referring to earlier, as in we can't just look at that and say, oh, that's immaterial and move on. No, we have to investigate why that is not 10%. And that generally involves determining whether or not that individual made a deferral change during the year. And then we would have to find out when that deferral change was. So in this case, maybe it went from 5% to 10%, and they changed it right around July. And so now you would have to recalculate that the amount that was withheld for the first part of the year was actually 5%, and then the second part of the year was 10%. And you'd have to recalculate that down to a very, very, very small difference. Because this is an area where the participant wanted 10% withheld. Why wasn't 10% withheld? Well, because they changed their deferral during the year. And that's generally where a lot of those differences come into play. But this is also where you would identify, well, if they wanted 10% withheld, but it didn't recalculate and they didn't change their deferral percentage, is it possibly a problem then with that definition of compensation? And that's where I find the plan sponsors generally make the most mistakes, is because they will improperly exclude bonuses from that definition of compensation when the plan document says that it's total gross wages. So then you're also testing the employer portion here as well. So that's an example of your contribution and payroll testing. You're also testing your distributions, and your objectives for testing distributions is to determine that the participant was eligible for the distribution, and the plan document will specify the types of distributions that are allowed and that they received the correct amount that they were supposed to receive based on the vesting provisions, and that taxes were properly withheld as applicable, and that the forfeitures were calculated properly. So some of the triggering events to be eligible for a distribution include termination of employment, reaching age 59 and a half, retirement, death, disability, or qualifying hardship. The plan document will once again specify which or all of these are offered and available to the participants. Distributions are also subject to the vesting, and vesting only applies to the employer portion of the contributions because, as we said earlier, the participants are always 100% vested in their own contributions. The vesting provisions will also be specified in the plan document, and generally it's some type of graduated vesting schedule like you see here, or it's a cliff vesting schedule. So in this example, if Mr. Smith terminated employment after working just over 3 years, what percentage of the employer contributions that had been allocated to his account would he be entitled to receive? So in this case, he's been employed over 3 years, but less than 4. So it looks like he would be at the 40% vested. So if he's only vested at 40% of the employer contributions, then the remaining 60% is considered a forfeiture. And the plan document will specify how those forfeitures are to be used. Can they be used to reduce future employer contributions? Can they be used to pay plan expenses? Or are they reallocated back to remaining participants? Or some combination of the two? So those forfeitures, they do have to be used within a specified period of time in accordance with the Internal Revenue Code regulations. What you don't want to see is a forfeiture account balance sitting there and continuing to grow and grow and grow. It should be used each year according to the plan document. With the forfeitures, the other thing that I'll mention is that they're based on the employer contribution. So when the employer makes that contribution, that's when it's recorded as a contribution to the plan. The forfeitures are not added back into the statement of changes because they've already been reflected there one time. But generally what you'll see is that it just moves from the participant account over to that forfeiture account. So you shouldn't see forfeitures reflected anywhere on the financial statements other than in a disclosure of what the forfeiture account balance was at year end and how they were used during the year. So here we have an example of a distribution work paper showing the participant's birth date, hire date, date of termination to help again determine eligibility and for vesting purposes. The date of the distribution, the amount of the distribution, taxes withheld, forfeitures being recalculated, etc. Now, one thing that you don't see on here that I do want to emphasize is that when you are testing your distributions, you want to make sure that you are testing at least one of every different type of distribution, whether it's from termination or retirement or hardship or death. They all have different requirements and restrictions. So you want to make sure that you're testing at least one of every different type as part of your distribution test. Participant notes receivable is another common area on your EBP engagements. If the plan document allows for participant notes receivable, this is where the participants will borrow money from their account. So the cash leaves the plan and goes to the participant, and then the participant pays that loan back, typically through withholdings from payroll. So we have to test to make sure that that participant note receivable is in compliance with the plan document and the IRS provisions, which state that the maximum loan amount is limited to the lesser of $50,000 or 50% of their vested account balance. Has to have a reasonable stated interest rate. The term cannot exceed 5 years unless it's for the purchase of a primary residence, and it must be repaid at least quarterly. Now, participant notes receivable are receivable on the financial statement, but they are a loan, considered a loan on the 5,500 and included with the investments on the 5,500. So if the participant loans are covered by the certification, then they're eligible for that certification in accordance with ERISA Section 103A3C. But remember, that only applies to items and investments at the plan level. All the activity for participant notes receivable is generally at the participant level. So I generally don't worry about whether the certification covers the participant notes receivable from a testing perspective, because I'm going to test participant notes receivable regardless. Now, they generally are immaterial to the total plan assets. So when it comes to testing, I'm not testing a huge number of participant notes receivable. It's usually anywhere from 4 to 8 participant loans. And again, that will vary depending on the risk and the plan, etc. But here's an example of a participant note receivable work paper with the participant's name, the date the loan was taken, the amount, stated interest rate, the payment at the term, and the maturity date. And so then I'm testing to make sure that the amount was limited to the lesser of that $50,000 or 50% of their vested account balance, that the interest rate is reasonable, that the term does not exceed 5 years, and then I'm agreeing the outstanding balance to an amortization schedule to make sure it is being repaid. And those are pretty much the standard procedures when it comes to participant notes receivable. I also will have a carry forward of the outstanding participant loans as well. So that brings us to our investments. With our investments, we're going to talk about a couple of different things that we need to understand, regardless if it's a 103A3C audit or not. We have to determine whether or not the investments are participant directed versus non-participant directed, and I mentioned that earlier. Your participant directed investments can be presented on a single line item on the financial statements, but your non-participant directed have to be broken down by type, either on the face of the statement or in the footnotes. We have to understand the different types of investments that are offered in that plan, regardless of whether it's a 103A3C audit or not. These are some of the common types of investments that you may encounter in your EBP engagements, with your mutual funds probably being the most common type of investment that you'll encounter. But you could also have your collective investment trust, self-directed brokerage accounts, and various insurance products as well. So let's just talk about a couple of these because we still see a lot of confusion when it comes to the investment disclosures and understanding exactly what it is that the plan owns for the investments. So a collective investment trust, or you may hear it called a CCT, these are created by banks or trust companies. That's the first distinguishing characteristic. A collective investment trust, or a CCT, is created, established, and maintained by a bank or trust company. There is no ticker symbol for that trust. It's not traded on an exchange anywhere. The way these trust works, the plan will contribute to the trust. The trust will purchase the underlying investments. The trust owns those underlying investments, and those underlying investments could be stocks, bonds, mutual funds, real estate, partnerships, insurance products. They could have any type of underlying asset that's owned by the trust. The plan owns units of participation in that trust, and the trust owns the underlying assets. So that trust is valued at net asset value based on those underlying assets. So that trust can be valued at the net asset value as either a practical expedient, which is excluded from the fair value hierarchy table, or it can be valued at the NAV as a readily determinable fair value. In that case, it is included in the fair value hierarchy table. You could also have stable value funds that are also issued by banks or trust companies. These are pretty much the exact same thing as a collective trust. The biggest difference is with the stable value is that their underlying investments are in insurance products, such as a fully benefit responsive GIC. And so people will get confused with these stable value funds, and they'll treat them as if they are a direct ownership in a GIC. And these stable value funds, they may even go as far as to tell you that they're valued at contract value. Well, what we have to remember is if that stable value fund is issued by a bank or trust company, it is still a collective investment trust. It's just called stable value based on the underlying assets. So that stable value collective trust will still be measured at NAV as either a practical expedient or NAV as a readily determinable fair value. We also have to understand that we have some insurance products as well that we're going to mention here in just another couple of minutes. But before we get to the insurance products, because they get even more confusing. I do want to go ahead and differentiate between an ERISA 103A3C and a non-ERISA 103A3C. So you'll notice here it's called full scope because that's what it was historically called, but now it's called a non-ERISA 103A3C. But nothing has changed. It's the exact same objectives, the exact same procedures that we used to perform when it was called full scope. Now it's just called a non-ERISA 103A3C. So we're not going to go through that in a lot of detail simply because nothing has changed in regards to these procedures over the last however many years you want to go back. In a non-103A3C audit, you're testing, this is as simple as I could put it, investment purchases, you're testing investment sales for the realized gains and losses, you're testing the fair value, and you're also testing the unrealized gains and losses. So with our non-ERISA 103A3C engagements, these are some of the example procedures that you would be performing. Obviously, a copy of the investment policy statement. You still have to understand the types of investments offered, trustee responsibilities, and like I said, you're testing the purchases, the sales, the fair value, the realized and unrealized gains and losses. So with the ERISA, non-ERISA 103A3C audit, these are some of the example procedures that you would perform when you're testing the purchase price and the investment returns. You're comparing information to external sources, such as getting that ticker symbol, looking at the date of the purchase, what was the price, what was it trading at, the return reported by the plan, etc. And this is going to be very easy to do if the plan holds common stocks and or mutual funds. For the CITs and or the insurance products, obviously you're going to want to get a copy of the audited financial statements for the trust and or the insurance product to help with some of this testing. For your 103A3C audits, you're not doing any of that detailed testing on the investments other than testing the investment income allocated to the participant accounts and their ability to change their allocations across the different investments. You would still want to get a copy of the investment policy statement even for your 103A3C audit and understand those trust responsibilities as well. Here we have an example work paper where we're testing the investment income allocated to participant accounts and their ability to change their investment allocation. This is a reasonableness test. And so they're taking, it looks like one fund per person, even though that participant may have allocated their contributions across 5 different investments, they're just looking here at one investment for that participant. And so you can see here, look at the second one. William selected the Vanguard 500, and they took William's beginning balance in the Vanguard fund and William's ending balance in that fund, took the earnings as a percentage of that average balance. So William had about 19.68% investment income allocated to his account for that time period. So we look at that Vanguard 500 for the plan. So the plan's total assets in Vanguard at the beginning of the period were the 1.8. At the end was the 2 million. Did the same calculation of the earnings as a percentage of the average balance. And for the plan as a whole, that investment had 18.9% earnings compared to the 19% allocated to William's account. To me, that's reasonable because there can be various fluctuations there depending on the percentage that William had allocated to that fund during the year. It can be affected by changes in the deferral percentage and or distributions or loans taken during the year. So as long as these allocations are reasonable compared to the plan as a whole, I'm happy. Now you can see here there's at least one, this first one, that's out of line, and that all has to do with timing as to when that person allocated or started contributing to that fund. Or maybe there was a large rollover. That's also going to impact when the earnings were allocated. I'm also testing here to see how much that participant allocated to that particular investment. Did they have 20% going to T row 2030, and then 20% going to another fund, and then 60% to another? So I'm testing that generally by looking at their participant-initiated transactions and the SOC report once again, and then testing to make sure it was allocated properly. And so that brings me then to the insurance products. So I wanted to talk about those separately because the insurance products can get even more confusing depending on the nature of those products. First thing I want to mention here is a pooled separate account. First of all, a pooled separate account is issued by an insurance company. Outside of that fact, a PSA is issued by an insurance company. A collective trust is from a bank or trust company. Those are the only differences between the two. A PSA works just like a collective investment trust, whereas the plan contributes to the PSA. The PSA purchases and owns underlying investments. The plan owns units of participation in the PSA. The PSA has no ticker symbol. It's not traded anywhere. And it's valued at NAV as either a practical expedient or NAV as a readily determinable fair value. Then you have your fully benefit responsive guaranteed contracts. Now, all of those investments we've talked about up to this point, we've explained how they're valued. They're valued at fair value, or NAV as a fair value, or NAV as a practical expedient. Your fully benefit responsive guaranteed contracts from insurance companies, these are measured, valued, and presented and disclosed at contract value. So every GIC that's directly owned by the plan has to be evaluated for that benefit responsiveness. And if it's fully benefit responsive, it's at contract value. If it's not fully benefit responsive, it's at fair value. So how do we determine whether or not the GIC is fully benefit responsive or not? Certain conditions have to be present. First of all, it has to be directly between the plan and the insurance company. The interest crediting rates adjustments, they have to be guaranteed not to be less than 0. We also have to look at whether or not the contract requires all participant-initiated transactions to occur at contract value without any types of conditions, limits, restrictions, or penalties. So that's going to include the participant is allowed to make changes for withdrawals, loans, transfers without penalties or limits or restrictions. They also have to have basically the guarantee that an event that limits the ability of the plan to transact at contract value is probable of not occurring. And the participant must be allowed to make changes to that contract at any time. So if those conditions are met, then that GIC is considered to be fully benefit responsive, which is then reported at contract value. So that brings us to our last area of testing here related to remittance testing, and we've already mentioned this a couple of times. So those amounts that are withheld from the participant's wages must be remitted to the plan as soon as possible. There is no safe harbor period for large plans. Those amounts have to be remitted as soon as they can be reasonably segregated from the general assets of the plan sponsor. If they are not remitted in a timely manner, that's a prohibited transaction, and it would have to be disclosed in the financial statements. It would have to be reported on the schedule of delinquent contributions. The plan sponsor would have to pay and make up the lost earnings, and they would have to pay excise tax because it's a prohibited transaction. Now, small plans do have a safe harbor for the remittances. Small plans only have 7 days. Large plans do not have a safe harbor. So there's no safe harbor. I can't stress that enough. 3 days, 5 days, 7 days, there's no safe harbor for a large plan. There's no safe harbor when it comes to someone being out sick or on vacation. Those are not legitimate excuses in the eyes of the DOL for why the amounts were not remitted timely. When it comes, like I said, to these timely remittances, a lot of times you're having to have that discussion with the plan sponsor if they're not consistent with their remittances, because that could obviously result in an untimely remittance. So again, we're looking at these remittances to evaluate when they were withheld and when they were remitted to the plan. Those are the consequences of the untimely remittances that I've mentioned a couple times. It's a prohibited transaction. It has to be reported on the supplemental schedule of delinquent contributions, has to be disclosed, lost earnings, and excise taxes have to be paid. I will generally give my plan sponsors a template to be completed where they list out every single pay date and then the date that it was remitted to the plan, and then have them include all of the employee contributions and loan payments, and even the employer contributions, just so I can use it for reconciliation purposes. And then I'll calculate the number of business days between the pay date and the remittance date. Now, I will have my plan sponsors complete this for the entire year. I know some auditors will just select certain pay periods and test those. That's entirely up to you and your professional judgment. But I will have my clients drop in this information for the entire year, and then I will agree specific months to bank statements and payroll and then reconcile it in total. And so then if you identify any of these as untimely, then again, you have the consequences that we previously mentioned for reporting purposes. So those are the big areas associated with employee benefit plan audits. And you've looked at various examples here of work papers as well. And we've already mentioned some of the common mistakes that are made. And so now we're just going to, wrap up and tie some of that up as to how these mistakes and errors can be corrected. So we have correction programs from both the Department of Labor and the IRS. The Department of Labor's correction program is their voluntary fiduciary correction program. And there are 19 specific transactions that are allowed to be corrected through the program. And they provide steps as to how these items can be corrected appropriately. A plan can enter into this program and make the corrections as long as they have not received any type of notifications from the DOL. And then once they've entered the program and the items have been corrected properly, they receive a no action letter from the DOL. Now, with the voluntary fiduciary correction program, this is the information that's required to be included, which includes a list of all the people materially involved, their EIN and address of the plan sponsor, the date of the most recent filing. Again, all of that information has to be provided for that application. The Internal Revenue Service program that they have is called the Employee Plan Compliance Resolution System. And there are 3 different ways that mistakes and errors can be corrected. They have their self-correction program, then they have a voluntary correction program, and then an audit closing agreement. And there are different requirements and restrictions for each type of correction. So these programs are available for all qualified plans, including 403B plans. And there have been some recent changes to the Employee Plan Compliance Resolution System that's expanded on some of these corrections. So please be sure and check out those new items in regards to the EPCRS. And in fact, the IRS does have what they call the Fix-It Guide for common 401k violations, and they include a lot of these expanded corrections in there as well. So these are some of the common mistakes made by plan sponsors, and some of these we've already mentioned. Definition of compensation, excluding eligible or including ineligible, plan loan administration, matching contributions, excess deferrals, untimely remittances, and failure to amend the plan document. So that IRS Fix-It Guide that I just mentioned addresses a lot of those items. And as you can see here from some of these corrections, the majority of the time, they just want the participant to be made whole, and they can make the participant whole either through corrective contributions or distributions made by the plan sponsor. So I'll give you just a half a second here to glance through some of these. With the incorrect definition of compensation, generally that does require the plan sponsor to make some type of qualified non-elective contribution to the plan to make those corrections along with lost earnings, or possibly a distribution has to be made to the participant. If the employer match is not made to all employees, again, they have to be made whole, so the plan sponsor would have to correct those employer matches that were not made along with lost earnings as well. Not allowing eligible employees to defer, so again, those participants would have to be made whole for the period of time they were not allowed to participate. And again, these are just some of the common corrections here under the IRS Fix-It Guide. And you literally can Google the IRS Fix-It Guide to Common Mistakes, and all of these items will be included, and they'll walk you through step by step how to make these corrections. So what is the auditor's responsibility when it comes to the mistakes that are made? We have to communicate them with those charged with governance, and we can communicate that either verbally or in writing. And the communication of internal control deficiencies, we would have to determine whether or not it's considered to be a significant deficiency or a material weakness. And then now, in accordance with SAS 136, if we do identify some of these issues and we use our judgment and determine that it's considered a reportable finding, then the reportable finding has to be communicated in writing as well. So that's our responsibility for communication. We also have that responsibility, obviously, to inform the plan sponsor, but then the plan sponsor has to make those corrections. So with those charged with governance, the required content here you can see is in regards to if we have a significant deficiency or material weakness, as well as a reportable finding should be listed here as well. So it would include any other difficulties that we encountered during the audit should be communicated, and any uncorrected misstatements. Differentiating between significant deficiencies and material weaknesses, again, is a matter of professional judgment. And there's been really no changes in these definitions the past few years between a significant deficiency and a material weakness. So we're not going to spend a lot of time going in detail about these definitions, but we do have a few examples here of what could be considered a significant deficiency or material weakness, because once again, you use your judgment to determine whether this falls into the category of significant deficiency or material weakness. So some of these examples include inadequate design of controls over a significant account or process, including improper valuation of investments, lack of controls over accounting for plan amendments, inappropriate accounting and disclosures for allocated and unallocated contracts. Some examples here related to insufficient control consciousness within the organization. Plan sponsor has outsourced the administrative function with no oversight. Lack of performance of tax compliance testing. They don't maintain sufficient records to support transactions. So those are some examples of what could be considered significant deficiencies or material weaknesses. So that brings us to our next section here related to other audit considerations. And some of these items we've mentioned briefly, but we're just going to touch on them here once again. Qualified plans are subject to certain compliance tests in order to maintain their qualified status. So these are some of the compliance tests that are applicable for defined contribution plans, which include minimum coverage testing, the non-discrimination testing, the ADP ACP, the benefit and contribution limits, top heavy, and then the deferral limitations test. Now, when we are reviewing the plan's tax status review, that also incorporates whether or not they are in compliance with those tests that we just discussed briefly. And remember that certain plans are going to be exempt from certain types of tests. Your safe harbor plans are going to be exempt from the ADP ACP test, but they're still subject to the other compliance rules. So when we're looking at the plan tax status review, we are determining whether or not they're in compliance with those tests, if they have failed or passed those tests. We're also looking to make sure that they are keeping their plan document up to date and all of the amendments have been made properly, because if they're out of compliance with some of these items, that could jeopardize their qualified status. And that qualified status means that they are exempt from income tax. So how do we review and determine whether or not they are in compliance? Well, first of all, it's not our responsibility as the auditor to ensure compliance with all of the requirements to maintain their tax status, tax qualification status. But if we do become aware of instances that where they may be out of compliance, then we would have to take the appropriate steps. So what can we do? We can obtain an understanding of the nature of the act and circumstance in which the potential non-compliance occurred, evaluate the possible impact on the financial statements, and then make sure it's appropriately communicated. So if they did fail the ADP or ACP test, we need to make sure that the plan is taking the necessary steps to make those corrections. So when we are reviewing those testing results, if they have failed the ADP test, then refunds are going to have to be made back to the affected participants. If they have failed the ACP test, then the plan sponsor is generally going to have to make a contribution to bring the plan back up to passing. But as we are reviewing those results, we have to appropriately disclose that in our financial statements when it comes to failing the ADP test, to make sure they have refunded the excess contributions appropriately. So plan tax status review is, again, making sure the plan document is up to date for any required amendments. Do we have the most recent determination letter? Does the plan appear to be operating in accordance with its provisions? And did we identify any exceptions during our testing that could indicate they're out of compliance with the plan document, which could jeopardize the tax qualification status? Review the plan provisions, ask management and others as appropriate if they're aware of any non-compliance issues, and then draft the financial statements for proper disclosures of tax status. So those are some of the procedures that we perform in regards to the plan's tax qualification status. Now let's talk about a couple of other areas that can sneak up on auditors and they're not aware of some of the procedures that they have to follow, especially in regards to initial audits. With an initial audit, if it's the plan's first time they've ever become subject to the audit requirement, well, we're going to have to present a comparative statement of net assets. So we're going to have to test those beginning balances to determine whether or not they are materially misstated and whether or not the accounting policies and principles have been consistently applied. So how far back you have to go to test beginning balances, that's based on your professional judgment. I would generally go back about 3 years, depending on facts and circumstances. But you do have to perform procedures to test those beginning balances. So the considerations for how far back will include how long the plan has been in existence, the longevity and competency of plan management, have there been any changes in service providers, the adequacy and organization of plan records. All of those are factors to be considered with how far back you need to test those beginning balances. Plan termination is also an area that sneaks up on plans, both the sponsors and the plan auditors. For plan determination, one of the important factors is when the decision is made to terminate the plan. So that date of termination is established once plan management or those charged with governance have made a decision to terminate the plan. And so the benefits and liabilities under the plan are determined as of the date of that plan termination. So that plan remains in existence, even though they've made a determination to terminate. That plan remains subject to the audit reporting requirements until all assets of the plan have been completely distributed. And once all the assets have been completely distributed, then the final 5500 is filed. If they make a decision to terminate before the plan's year end, then that's the liquidation basis of accounting, which everything has to be at fair value, which it should be unless they have fully benefit responsive GICs. Once a decision has been made to terminate, too, all of the participants become treated as 100% vested. But if that decision to terminate is made after the year end, that's just a disclosure only. It's not liquidation basis. Liquidation basis is only when the decision is made before the plan's year end. So a couple of other considerations here, just as a reminder, the original Secure Act had some provisions that became available as of 2020 and 2021, and continuing on from there. Those provisions in the Secure Act do require amendments to be made to the plan document. And so those amendments do have to be made by December 31st, 2025. Again, this is just a summary of a few of those Secure Act, the original Secure Act provisions that were, put in place starting 2020 and 2021. We now have Secure Act 2.0, which has a lot of changes in regards to employee benefit plans. And you have to read Secure Act 2.0 very carefully because some of these effective dates start in 2023, 24, and 25. So I encourage you to very carefully review Secure Act 2.0, discuss it with your plan sponsors and even the service providers so that these provisions can be put in place properly, from their effective date. And these provisions under Secure Act 2.0 will also require amendments to the plan document. But as you can see here, we have changes related to the expanded automatic enrollment programs for 401ks and 403bs. They're increasing catch-up contributions and tax incentives, and also increasing the RMD ages once again. Plan documents also have to be modified and amended for those changes that were previously enacted under the CARES Act. And those changes under the CARES Act also have to be amended by December 31st, 2025. So that brings us here to our financial statement preparation and reporting and wrap up. So with our financial reporting framework, those financial statements can either be in accordance with GAAP or they can be in accordance with other comprehensive basis of accounting. Both are completely acceptable for the Form 5500 filing and for the financial statements themselves. The auditor's report, you have different opinion and reporting options, and hopefully for both your ERISA 103A3C and your non-103A3C, you will have what's called an unmodified opinion, which would mean it's a clean opinion. So that would be your unqualified, but then of course there may be times and situations where that opinion does have to be modified and you end up issuing a qualified, adverse, or disclaimer of opinion. The AU-C section 703 provides lots of examples on the auditor's report. SAS 136 does as well, and the AICPA has also issued some frequently asked questions that has guidance on the audit report as well. This is just a snippet, and it's just a very, very short snippet of the beginning of the auditor's report for the 103A3C audit. Again, where it starts out with scope and nature, and then it's got part of the opinion, just to emphasize now that your unmodified opinion for the 103A3C does have a two-pronged opinion. So SAS 136, we've mentioned that a couple of times. That's been in effect now for a while, so we're not going to go through SAS 136 in a lot of detail. This is just, again, a reminder that you do need to be using the new requirements and the reporting options here in accordance with SAS 136, with the additional language related to engagement acceptance and communications with those charged with governance regarding significant risks, making sure all of your documentation is up to date. So again, I'm not going to go through SAS 136 in a lot of detail since we've talked about it now for numerous years. And it's been in effect now as well. So again, I just want to reiterate here on the auditor's report, please make sure you are using the right auditor's report. That is one area where the Department of Labor is going to be basically pulling any of the audit reports from the EFAS2 system that are not in the correct format, and possibly rejecting those filings for failure to use the correct audit report. So I can't stress that enough, to be sure that you are using the correct auditor's report in accordance with AUDC Section 703. So these are some of the common report modifications, which include initial audits. So you would have to include how the prior year was presented for that initial audit. Was it compiled, reviewed, or audited, or was the prior year audited by a predecessor? The framework that's being used, if it's not in accordance with GAAP, you have those modifications for what the applicable financial reporting framework is. Modifications related to changes in service providers and or plans that are terminating. We've already looked at our statement of net assets available for benefits. And here again is just a reminder of what those categories are on that statement of net assets available for benefits. And we've talked about these common errors that are made. These are just some additional ones related to administrative type mistakes, non-filing of the Form 5500, allowing non-qualifying hardship distributions, non-qualifying loans, not following plan requirements. DOL investigative focus. In one of the areas is where they are missing terminated vested participants, where they can't be located, and so they're still sitting in the plan, and how to address those missing terminated participants now and in the future. So they're continuing to work on ways to address that problem. Incorrect or missing plan documents and disclosures, missing or inadequate bonding, conflicts with plan management, and assets that are hard to value. So those, again, are just some of the areas that the DOL continues to investigate. Here are a list of the resources that were used, to pull the information together for our discussion purposes today. So I do want to thank you, first of all, for your participation, and look forward to seeing you on future webcasts. Thanks so much, and good luck on your EBP audits.